This is the video about the inventory account, or what we might know as the stock account. This is the value of products that the business will have that's ready to sell. And we normally account for stock or inventory, and if the business owns stock or inventory, we count that as an asset. It's a current asset in the statement of financial position because we expect the value of inventory to change, either increase or decrease over the next, or at least within the next 12 months. So it is something that would appear in the statement of financial position at the year end, and at the year end it is seen as an asset, a current asset. And since it's an asset, and we know from our dead click rules that every asset has a balance brought down on the debit side. So this also will have a balance brought down, which is the value at the beginning of the year on the left or the debit side. So that's going to be on this side. So the brought down or the starting figure value for the beginning of the next year will be on the debit side, left side, because that represents an asset. Now, just quickly run through a few things. The inventory valuation that we put in the inventory account is a figure for the value of inventory and not the number of items of inventory. That means that the valuation figure is made up of the number of items of inventory times their monetary value. And that gives us a monetary value of inventory which goes in the inventory account. And we normally will ask the business for a closing inventory valuation, which is supposed to be a valuation, and they might do a stock take to work out the number of items of inventory and their value to give us a valuation figure, or it may well be an estimate, but that's the figure that goes in the inventory account as the closing inventory valuation. We do not anticipate any profits within inventory, so if we buy inventory and we expect we can sell it for more, that's what a business tries to do, sell it for more. We can't anticipate that increase, that profit within the inventory account. That would go against the realization concept. Basically, we can only realize gains or profits once they've actually been achieved or seen. So in that case, we can't anticipate profits, and therefore we should usually account for inventory at the beginning, and therefore we should only account for inventory usually at its cost value or its original purchase price, what we paid for it, unless it goes down in value. Net realizable value, or NRV. We can value inventory at whatever is lower cost or net realizable value. So if net realizable value of the inventory, how much we can get for that inventory, is less than the cost, then we can reduce the value of inventory down to its net realizable value, which could be lower than the cost. So this would happen when we're calculating the closing inventory valuation. And that's because we are always trying to be prudent, and we're using the prudence concept here, which is to not overestimate profits, to show expenses or losses as soon as they are probable. So in this case, we think that the value of inventory has fallen, and therefore we will reduce the value down from the original purchase price, the original cost, down to a lower value, which is the net realizable value. If the net realizable value of inventory is higher than the cost, then we do not change it to a higher value. We leave it at the lower of the two, either the cost or the net realizable value, whichever is lower. Okay, but we always start with the inventory at its cost value, and we never value inventory at higher than the cost, because we don't know if that additional profit that we assume will ever be made. Okay, also the cost of the inventory is the cost of the purchase, cost of any conversion, which might require labor or materials. We might take inventory and do something to it, might be in a factory where we convert it, so it would add the cost of all that. And any carriage in, transport costs would also add in. So for further details on all that, you're going to have to see my bigger video on inventory. To calculate inventory, we may just ask the business for a closing inventory valuation. They may do a stock take and count up the number of units of inventory times their value, give us a figure. They might run a continuous stock measurement system, such as FIFO, first in, first out. That basically means that whatever inventory we buy, if we buy inventory over 3 days, the first inventory that's sold will be the one that was first in, the one we bought on the first day, the earliest one. We could use LIFO, last in, first out. So we buy inventory, let's say over 3 days, And the first out, the first one we sell, would be the one that we bought on the last day, the most recent day. And so that way we would have a different cost of that inventory because we assume we have inflation and inventory goes up in price. Not necessarily every day, but it possibly could do. Or AVCO, which is average costing. Now LIFO, last in first out, is not permitted to be used according to International Accounting Standard number 2. So we're going to disregard that. Okay, so let's get to the inventory account. So we said already that the inventory account is an asset account. So it works like an asset. That means that the value of the asset increases on the left side, decreases on the right side. So any brought down, we already mentioned, on an asset account is always on the debit side. So the balance that we bring down, let's just say last year's closing balance was £8,000 or dollars. So we're going to bring down 8,000 on the debit side because this is an asset. So the brought down is always on the debit side. And that is whatever the closing inventory value was at the end of last year, we just bring down. Now, at the end of the year, that 8,000 will be transferred to the statement of financial position and it will go under assets. It will go under current assets in the statement of financial position. So that is done. The brought down is done on the debit side, and now since the statement of financial position is done for the end of last year, we now have to run the business for another year before we do another statement of financial position. Now to run the business for another year, we need to transfer that inventory into the cost of sales. So the cost of sales account in the income statement or statement for profit and loss normally would look like this. Cost of sales is your opening inventory, you add any purchases. And remember, this is the cost of sales. So this account itself is an expense or cost account. It is the cost of the sales, which means it's an expense account. So opening inventory acts as part of the cost of the sale. So it increases the cost. Any purchases of inventory we make increases the cost of the sales. Any purchase returns or returns outwards we make reduces the cost of sales. So this being a reduction in the cost of sales acts like an income account. Carriage in adds to the cost of sales. Any transport cost to bring the inventory into our business adds to the cost of the inventory, adds to the cost of the sales. Any drawings of inventory the proprietor takes home reduces the cost of inventory because they're taking it out of the purchase's cost. And closing inventory we minus from the cost. So closing inventory is also seen as an income. And then this equals the cost of sales. So the cost of sales account itself is an expense account. Expenses increase on the left from dead click and decrease on the right. So the opening inventory adds to that. Purchases and carriage in, they are all part of, or they all increase the cost of the sales. And items on the other side all decrease the cost of sales. Now, so we said that the opening inventory in the cost of sales is part of the expense, part of the cost, so it increases the cost on the left. Now we need to do the double entry. As soon as we see 8,000 in the inventory account, we have accounted for that in the statement of financial position at the end of the year. We do not track inventory within the inventory account, we just introduce or include the value of closing inventory at the end of the year in the inventory account. But otherwise, we deal with inventory during the year in the cost of sales. So we transfer out the inventory, opening inventory, that's the inventory we have at the start. We transfer that out into the cost of sales account, 8,000. So we debit the cost of sales, we credit the inventory account, and we get rid of the opening inventory out of the inventory account so it can be used and be useful within the cost of sales account within the income statement or statement for profit and loss. On the debit side, because that adds to the expense. Then we do the year, we have the items within the cost of sales. Now at the end of the year, we minus the closing inventory from the cost of sales account, from the income statement. We take it out of there, we credit that item. So let's imagine, for example, the value of closing inventory, whether you've worked it out by FIFO or AVCO, or you've done a stock take, is 10,000. So we would credit that account with 10,000. It's the same as minusing it from the cost of sales. We take it out from here, 10,000, we credit that account and we debit the inventory account with the closing inventory value. So that value has come from the cost of sales transferred. Remember, the income statement has now done the year. Now we transfer that back into the inventory account so we can get a figure for the statement of financial position for the inventory from this account. So closing inventory is put into here. Now if the inventory at the end of the year is damaged and we cannot achieve a cost value of 10,000 and the net realizable value that we can get for it is only, let's say, 9,000, then in fact this value will need to be reduced down to the net realizable value, 9,000. So that will then also only be 9,000. Okay, so we introduce at the end of the year the closing inventory back into the inventory account on the debit side. Now we need to balance this account. Now if you add up both sides, this side has a missing number, this side adds up to 17,000. That is the larger total, so we put it in for both sides. Now we have a missing number of 9,000. That is the balance on this account to carry down at the end of the year. That then becomes the balance brought down at the start of next year. Balance brought down. So that figure there, the 9,000, is the debit brought down at the beginning of next year and is the closing balance at the end of this year. And this is the value of closing inventory that would appear at the end of this year, in this year's statement of financial position in the current asset section, that 9,000 there. Okay, so this is the inventory account. Perhaps for most of us we don't need to deal with the rest, but it's good to have an understanding of how it fits together with the rest of the financial statements. But you may just need to focus on the inventory account, and we have the brought down on the debit. That gets transferred out into the cost of sales. That's the opening inventory that gets transferred out. Then we do the year in the income statement and then bring back in the closing inventory value from the cost of sales. And that value is determined either by doing a stock take, or we use FIFO or AVCO to work out the value of that closing inventory that we bring in here. Also, if it is damaged, we will reduce the value down if the net realizable value is lower than cost. If it's not lower than cost, we leave the value at cost. And that's brought in here. The closing inventory is brought in back on the left hand side, the debit side. The balance to carry down, the balancing figure, is worked out on the credit side and brought down as a brought down on the debit side to start the next year with. And that's the value that goes in, this is the value that goes in the statement of financial position at the end of this year. Okay, I hope that makes the inventory account clearer, and you can see more in my main video section.